Welcome back to the deep dive. We've got a really interesting stack of sources today. We're pulling together threads from, well, the cutting edge of Bitcoin finance, some genuinely surprising stuff in the stock market, and trying to figure out what it means for you. So our mission, as always in these deep dives, is to take this material you've shared, cut through the noise, get to the important bits, and make sense of it all. We're using your sources as our guide, basically giving you a shortcut.
Exactly. And the material today really gives a unique view. You see traditional finance, big companies, even governments starting to interact with digital assets. It's shifting the landscape. Plus, yeah, some perspectives on the market recently that might make you rethink things.
All right, let's jump right in then. The sources start with something pretty novel, Bitcoin bonds. We saw news about Sberbank, Russia's biggest bank, launching something like this. It sounds different. What exactly is a Bitcoin bond based on this?
Well, at its heart, it shows something simple the sources highlight. Bitcoin's become a magnet for capital. People, institutions, they want exposure. So a Bitcoin bond is basically just a dead instrument, but the return, or maybe the structure, is tied somehow to how Bitcoin performs. And your sources point out a couple of main ways this is happening. One is public companies issuing debt. They're raising money specifically to buy Bitcoin, often through things like convertible notes.
Debt that can turn into stock later.
Right. Potentially, or structured notes where the return is linked to Bitcoin's price. Think about MicroStrategy. The sources use them as a key example. They issue bonds, people like you buy them, and MicroStrategy uses that cash to load up on Bitcoin. Their convertible bonds, for instance, sometimes had like 0% interest. But bondholders got downside protection, better standing than stockholders if things went south. The catch: you could only convert to stock at a much higher price than it was trading at maybe 30, 40, 50% higher. The insight there is how they're using traditional debt markets for a non-traditional asset, creates new kinds of risk and reward for investors wanting that indirect Bitcoin exposure.
Okay, so that's companies using debt to buy Bitcoin. What else?
There's another idea getting traction called bit bonds. This is different. It involves a government issuing a bond. Let's say you buy a $100 bond. Instead of using all $100 for, roads or whatever, maybe they use $90 for that. And the other $10, they use it to buy Bitcoin.
Interesting. So how does the payout work for the bondholder?
That's the innovative part. You get a base interest rate, maybe low, like 1% in one model discussed. But crucially, you'd also get a piece of the action if the Bitcoin they bought goes up. The sources talk about models where, say, the first 4.5% gain from that Bitcoin portion goes straight to you, the bondholder. Anything above that might be split, maybe 50-50 between you and the government.
So the government still gets most of the money up front.
Exactly, 90% in that example. But they can attract buyers with this potential Bitcoin upside, and they keep a share of the profit, too. The sources even mention analysis suggesting this could maybe help with national debt, though that's flagged as uncertain. The key takeaway on bit bonds is governments exploring ways to use debt not just for funding, but to get strategic Bitcoin exposure and offer attractive returns.
And that Sberbank bond you mentioned earlier.
Right, back to that one. The sources note its value is linked to two things: Bitcoin's price in US dollars and how the US dollar performs against the Russian ruble. So that adds another layer, a geopolitical one. It shows how these new instruments can mix asset risk and currency risk. Really complex stuff, especially in places like Russia.
So the bond market, this huge fundamental part of finance and Bitcoin, are starting to marry, as the source puts it. People are designing new ways to invest because adding Bitcoin is seen as a potential performance booster, attracts capital. It's a new frontier, which kind of leads perfectly into the next point. Countries actually holding Bitcoin reserves. We saw Pakistan announce a strategic Bitcoin reserve. Is this just the beginning, according to the material?
The prediction in the source is pretty bold. It basically says they're all going to do it, meaning expect more countries to start stockpiling Bitcoin for strategic reasons.
Why, though? What's the thinking?
Well, think about the analogy the sources use. A country holding Bitcoin is like having strategic reserves of other key stuff. The U.S. has oil reserves, gold reserves. The sources even jokingly mention cheese reserves,
Right.
apparently. But the point is, it's about holding assets for strategic purposes. Economic shifts, geopolitical risk, simple diversification. And the sources list multiple reasons why countries might buy Bitcoin. Store of value, sure. Censorship resistance, that's important for some. Price appreciation, obviously. Maybe worries about future U.S. sanctions or the dollar's long-term stability, or just putting it in their sovereign wealth funds. The core idea is nation-states are starting to see Bitcoin strategically, not just speculatively, as a potential tool for their balance sheets, maybe even geopolitics.
That adoption path is just fascinating. It's so different from normal tech. Usually it's military or government, then big companies, then it reaches regular people.
Hmm.
Bitcoin totally flipped that. It started with individuals,
Mhm.
cypherpunks, early adopters, often facing skepticism. And now it's climbing up the stack, individuals, then companies, financial institutions, sovereign wealth funds, and now maybe nation states. That bottom-up thing is pretty unique.
It really is.
So speaking of nation states, the U.S., the sources talk about the U.S. government may be buying Bitcoin. They
Yeah.
even float a number like 1 million Bitcoin. How would the U.S. government even do that, realistically?
The source outlines a few ways. One is, well, issuing debt or printing money. The source kind of frames it as maybe a good use for printed money, given Bitcoin's potential compared to other things they might spend on.
Okay, printing money or issuing debt? What else?
Adjusting the budget, just redirecting spending from what the source calls dumb things towards buying Bitcoin. Simple reallocation. And the third way is earning it or acquiring it differently. Maybe using U.S. energy for mining, or asking for Bitcoin payment from other countries for certain things, or maybe getting their share from those Bit bonds if they ever happened,
Right.
and putting that profit into reserves.
There's a warning in there too, right?
A crucial one. The source stresses it must be done in the proper way, which means, explicitly, no nationalizing companies or Bitcoin ETFs. No coercion, no violence, no seizing assets. It has to be transparent, legal market purchases. The method really matters here, respecting property rights.
And the source suggests, from a market standpoint, you probably don't want to bet against the U.S. government doing this eventually. If they did buy and announce it, especially with some officials sounding positive on digital assets, the price impact could be huge.
Exactly. Which ties into another concept. Bitcoin becoming a kind of hurdle rate. Because it's appreciated so much, it sets a really high bar for other investments. What else gives you that potential return? So the simple strategy for many, the source suggests, over the last 15 years wasn't fancy timing. It was just dollar cost averaging. Buying regularly, ignoring the noise. It's maybe becoming for a new generation what just buying the S&P 500 was for older ones. A bet on long-term growth.
Okay, let's shift gears a bit. There's a common question people ask.
Mm.
If big companies, maybe like GameStop or others, announce they're buying billions in Bitcoin, why doesn't the price just, moon instantly?
Right, good question. This gets into the weeds of market mechanics, specifically hedging or arbing, as the source describes it in this context. When big, sophisticated players buy stock in a company that holds a lot of Bitcoin MicroStrategy, is the classic example again, they often simultaneously short Bitcoin somewhere else.
Short Bitcoin.
Yeah.
So they bet on the price going down.
Not exactly betting it goes down, but neutralizing their price exposure. Let's use the source's logic. Say you buy $105,000 worth of a company's stock, and that stock theoretically represents 1 Bitcoin the company holds. But maybe the stock is trading at a premium. Let's say it's trading at 150% of the value of that Bitcoin. A smart investor might try to capture that premium. They buy the stock so they're long the company and its Bitcoin. But at the same time, they short $105,000 worth of Bitcoin itself.
Okay. So long the stock, short the Bitcoin. What does that achieve?
It makes them basically neutral on Bitcoin's price movements. If Bitcoin goes up, their stock position gains, but their short loses, and vice versa. It mostly cancels out. But what they do capture is that premium the stock was trading at, assuming it eventually shrinks or disappears. So the key insight: a lot of that big money flowing into Bitcoin proxy stocks gets immediately neutralized by short hedges elsewhere. That dampens the direct upward pressure on Bitcoin's price. Doesn't mean it stops it rising, clearly, but it explains why it's not just exponential on those announcements.
Okay, that makes sense. Hedging pressure. And staying on market stuff, sources mentioned the Bitcoin hash rate hitting an all-time high. Remind us what that means.
Hash rate is basically the total computing power working on the Bitcoin network, mining power.
And why is it going up so much?
Sources point to a few things. One, hardware just keeps getting better, more efficient machines. The difference between old miners and the new ones, especially with things like immersive cooling, it's huge. More hash per watt. Two, miner incentive. People want Bitcoin. The price gives miners a reason to deploy more capital, more machines. It's competitive, but the reward is there.
Right.
And three, just the general trend of more computing power globally. The economy is shifting towards computation, data, AI. Bitcoin mining benefits from that overall increase in available processing power worldwide. So a rising hash rate signals a healthy, secure network, driven by tech, economics, and this broader shift.
Okay, let's pivot completely now to the traditional stock market. May was surprisingly strong. Sources say it was the best May for the S&P 500 in 35 years, a 6% return.
Yeah, and the really interesting part, according to the sources, is why it was such a surprise. A lot of people, a lot of market participants were positioned completely wrong. They were offsides, expecting a downturn.
Why the pessimism?
A big part was trade policy, tariffs. The consensus view was that tariff talk was just, political noise. When the tariffs actually happened, the market logic seemed simple. Tariffs are bad for trade. That means inflation, and inflation means stocks go down. That was the dominant narrative.
But that's not what happened.
No. And the sources draw this parallel to Kyle Bass shorting the housing market back before '08. His success wasn't just seeing a bubble. It was asking, what if? What if the trend everyone assumes will continue, housing always goes up, what if it doesn't?
So applying that here,
The source applied that thinking to tariffs. Instead of just accepting tariffs bad, they asked, what if they don't cause the predicted inflation? What if the goal is different? They listened to the actual decision makers, who maybe had a broader strategy, even if that view went against the market grain and got them flack. The insight is, sometimes you have to question the consensus, look beyond the simple cause and effect everyone assumes.
it reminds me of that Buffett quote the source used. The market's a voting machine, short term, all sentiment and fear. Hence maybe that 20% dip earlier, but it's a weighing machine long term, reflecting actual fundamentals.
Precisely. And speaking of fundamentals in history, the sources bring up data from Ryan Dietrich. It shows that when the S&P gains over 5% in May, historically, it's been an incredibly strong bullish signal.
Yeah.
Like 100% of the time, the market was higher. 12 months later, the average return was around 20%. Now, history doesn't repeat exactly, but as the source says, it sure does rhyme a lot. Supports the prediction of new highs this year.
So this could be called the most hated rally because so many people fought it. The market just acted like a referee saying, nope, your framework was wrong.
That's a good way to put it, yeah. And during this rally, you saw retail investors acting very differently from institutions.
So,
Retail buying power was huge. The sources say U.S. retail investors poured about $50 billion into stocks since maybe March or April. And crucially, they bought most heavily on the down days. They were aggressively buying the dip.
is there data on that?
Yeah, a striking statistic. The day after a down day where retail bought heavily, the market performance was way better, like 0.36% gain on average. Compare that to the historical average after any down day, which is only 0.02%. The implication is huge. Retail dip buying seems to be having a real, statistically significant impact on market resilience this cycle. They're not just passive anymore.
And this isn't small potatoes. Retail share of the market is growing, around 36–38% now. The source even predicts they could eventually overtake institutions.
That's the prediction. It's driven by the rise of self-directed investing. Fees are coming down, AI tools for allocation are getting better, more people feel they can manage their own money now. Top advisors are still vital for complex situations, sure. But for many, DIY investing is becoming the norm. The market structure is fundamentally changing. Retail is a much bigger force.
Okay, so as we start to wrap up this market discussion, what should we be watching, according to the source, to see if this strength continues for those new S&P highs?
The source watches a few key things. Continued money printing, the deficit blowout. It's presented as, bad for the country fiscally, but historically good for asset prices. It's a weird dichotomy. GDP growth Q2 expected to be strong, pushing back recession fears. Job growth needs to stay steady. And then potential deregulation, tax breaks things seen as boosting capital and innovation.
Anything else?
Yeah, the big one, global liquidity. The source basically says it's right there in front of your face. The chart just goes boop, boop. All that money sloshing around tends to lift asset prices. So despite the pessimism out there, these core indicators still look supportive for risk assets, according to the source. And maybe one final point on the commentary side. The politics. The source suggests that seeing everything as just blue versus red really blinded a lot of people to what was actually happening economically and in the markets. There's value in looking topic by topic, judging policies on their own merit, not just who proposed them. Apparently, getting criticized for bias by both sides might actually mean you're thinking independently, not just towing a party line. Political bias can be a huge blind spot in analysis.
Wow, okay. That was definitely a deep dive. We covered so much Bitcoin bonds, countries maybe adopting it, the weird stock market rally, retail's growing power. We really hope this gave you some valuable insights, a shortcut to understanding these complex things, maybe a few aha moments, a new perspective.
And maybe leave you with this final thought, drawing from the material. If so many people apparently missed this stock rally because of their preconceived ideas or political lenses, How much might our own biases be clouding our view, not just in markets, but, everywhere? Is the market really the ultimate referee, just showing us when our view of reality is off?
Definitely food for thought. If you found this deep dive useful, please do follow, like, and share the show. And you can follow What Bitcoin Taught Me for more on Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. Thanks for joining us.